Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 6th of August. I'm Daniel Lam, your host for the podcast. This week, we've been talking about potential consolidation or short-term risk-off. Now, naturally, in such an environment, one would be looking at gold. Now, for the last 4 months, gold has been relatively unexciting, moving most of the time in a range between 3,250 and 3,400. Now, over the past week, gold prices have edged towards oversold territory and testing the 100-day moving average, a technical support that has not been reached since the start of 2025. Now, gold has strong correlation with the US dollar, which had been strengthening due to a series of tariff announcements and a more hawkish than expected FOMC. However, the weakness in last Friday's non-farm payroll number changed the situation. Investors are once again seeking safe haven assets such as gold and the yen. Investor positioning in gold is not overcrowded, and the gold market is now coming towards the end of a seasonally slow consumption period, which means potential fiscal market support. Macro drivers such as real yields are driving gold once again due to softer demand and tariff uncertainty persisting. This would lead to a more demand on exchange-traded products (ETPs). While central bank buying has been the crux of the gold price rally since the second half of 2022, ETPs this year have been leading the gains in the first half of 2025. In fact, the World Gold Council second quarter 2025 report reveals that central bank buying fell to its lowest level since the second quarter of 2022. Total demand dipped to a one-year low, and ETP demand growth offset some of the weakness, but not all of it. So we're seeing factors acting in tug of war, i.e., a further slowdown in central bank demand would impact gold prices, but the weaknesses in US economic data will limit the downside in gold. Net-net, we believe it makes sense to slowly accumulate gold near the 3,300 and 3,100 levels in order to hedge the growing macro uncertainties, especially the situation where inflation remains firm while growth weakens. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.